All right, guys, welcome back. This is our second meeting for the options website. My name's Max. I'm back. I'm glad you're back, and we're just going to get right into it. So, as I was talking about in the previous video, this is an ETF, the S&P. An ETF is an exchange traded fund, meaning it's a fund of a bunch of different parts of companies. So it's basically an example of how the broad market is performing. Now let's get right into options. What is an option? I know it sounds weird, the word option, but the gist of it is that an option is the option to buy a stock at a certain price. So think of it this way. Um, let's say Bob, I'm going to pull up my little paint tool here to give you guys a better look. Let's say Bob has a house. You know, it's a one bathroom, one bedroom, but I like this house. So I go to Bob, I say, listen, Bob, I don't know if I want to buy this today, but would you let me buy it for $100,000 within the next 5 years? And Bob says, well, what if my house is worth more in 4 years? You say, okay, I'll give you, Bob, I'll give you $2,000 if you sign a contract saying I can buy this house for $100,000 within the next 5 years. So you give your $2,000 to Bob and you go about your day. Now, what happens is you're shopping around, you're waiting years and years. Now, 3 years later, the housing market has gone up a crazy amount in value. And let's say his little house is now worth $200,000. You're like, wow, I wouldn't be able to afford that. But luckily, you paid Bob. You now have a contract to buy his house at $100,000, and you're still within the time frame to do so. So you go back to Bob, you say, I'm here to buy your house for $100,000. And he says, wow, that's a good deal. Now you have a house for $100,000, and you can just turn around and sell this house for $200,000. And you make a profit of 98,000 when you factor out the $2,000 you paid him for the contract. And that's a little metaphor of how the options market works. Um, Now, options are inherently more risky than just buying and selling stocks because they are much more volatile. They do not have, in often cases, they do not have intrinsic value to them, unlike stocks where you buy a right to the cash flow of a company. Um, but we're going to teach you how to conservatively use options as a strategy as part of your portfolio to supplement your investments, maybe even hedge against downward or upward movements in the market. Um, but this is just educational. Options can be used as a tool to make or lose a lot of money, but that's not what you want to do. Never gamble. What you want to do is use them in synthesis with your stocks to play it even safer than simply owning shares of a company. Um, so in the stock market, I'm going to kind of show you this metaphor in the stock market. So on the 1 day chart, this is the movement that the S&P moved today. So it opened up at $430, give or take, and it was all the way down to $420. And then towards the close, it kind of rallied and we closed around $440. So let's say I bought the option to buy this stock at $420. Now I could pay around $5 per share. Each contract is 100 shares. So $5 per share times 100. I could pay about $500 for the option to buy 100 shares of the S&P at $420 this week. And then when I see the S&P at $440, I can execute that option. I can actually buy those shares for $420 each. Now I'm a rich man. Not a rich man, but this is how some people use options. And this is basically how options work. I'd like to show you there are two different types of options. Number one is a call. Think of a call like buying a stock. Think of it as guessing that the stock will go up. You're hoping that the stock will go up. Now, on the other side of that, a put option is like shorting a stock. You think that a stock will go down. So if you're bullish on a stock, what you do is you buy a call. If you are bearish on a stock, you're going to buy a put. Now, I know this may sound confusing, but it's actually really simple. Each call or each put has a price that you are willing to pay. You're contracting it out. So as you can see, this is the stock symbol right here, XYZ ticker. Lots of people like to trade Apple or SPY, Microsoft, Boeing, Netflix, any stock, usually blue chip stocks, all of these stocks, you can buy options on them. So you choose the stock that you're bullish or bearish on. You you go to the options chain. So XYZ, let's say this is Apple. You choose a day that you think the stock will make a move by. So if I'm bullish on Apple, I say, wow, you know what? Apple has a really big earnings report coming out. And I think by February 1st, Apple is going to be up a lot. So I'm going to put the date that my contract expires. So I can only buy my shares at the price that I want by this date. So Apple, February 1st, call because I think it's going to go up. And let's say Apple's trading at $100. I will buy a $110 call. And that would cost me, it's priced per share. So each option, if it says 303.10, it actually costs you $310 as you can read down there and down there. So if I think Apple's going from $100 to $150 after this huge earnings report, and I have about a week to February 1st, I'm going to buy this Apple February 1st 110 call. And I'm going to pay a given amount of money for that. Now, theoretically, let's say this does happen. The next day, Apple goes up $50 on a blowout awesome earnings report. Now your option is worth a lot of money because you are essentially holding a contract saying, yes, I can buy 100 shares of Apple at $110 before this date. Now, when Apple's at $150, you can buy it for cheaper than it really is. So you have two options at this point. Two options. Your first option, execute your option. When you execute your option, you actually buy your shares. You buy your 100 shares at the strike price that you chose. But the second and more common option is simply selling your contract to someone else because there's always a bigger fool. There's always someone who will buy the contract from you because they think that the stock will continue making its move. So when you're done, when you've made your money, most likely you are going to sell your contract to a third party and you profit the difference in price. If Apple's at $100 when you buy the contract and it's at $150 when you sell it, you're definitely going to make a lot of money. Now, this strategy is simply called buying an option. There's so many different ways that you can utilize options, but this one we do not recommend. Buying options is usually for people who are open to excessive risk with small portfolios and don't care if they lose or make money. We are going to teach you ways in further videos to use options to make small amounts of money safely or to protect yourself from losses in your investment portfolio. So thank you. Hopefully you got a small basic understanding of options before we get even deeper into this, and catch us in the third video where we will be going into more of the technicals and helping you get a better understanding of how options work. Thank you. We'll see you there.